I'm going to start off this video and clear up a few misconceptions. I've seen a couple of articles lately suggesting that um, the markets are working naturally, especially the gold market. And and folks, if you believe this, then you might as well start handing your money to the banks right now. Uh, Gold, pure and simple, is one of the most heavily manipulated markets on the planet, other than maybe the currencies. And if you don't, if you can't accept that fact and you don't plan for it, then you're going to lose money. Um, the position limits um, in the gold market are supposed to be 3,000 contracts. Uh, that hasn't been the case. Well, it hasn't been enforced in years. And that's why you get things like this, where today, and we knew that this was a strong possibility that gold was going to be attacked today. You get um, you know dumps of 4,000 and as high as 15,000 contracts in the pre-market. Folks, I'm here to tell you, in a natural market, that's never going to happen. Nobody is ever going to dump um, 5, 10, 15,000 contracts in the pre-market because this is what happens. It wipes out all the bids and the market collapses. So if you're trying to sell a position and make as much money as possible, this is the worst possible strategy you could use. This strategy is only good for knocking price down. Um, Let me move back to last Friday. Here's an even better example. This was options expiration. Um, uh, the banking cartel wanted to knock the price down for options expiration. They dump 15,000 contracts, 10,000, 11,000 contracts here. And what happens? The price of gold collapses because there's just uh, no interest in the pre-market that can soak up this kind of selling. So the comment was made that the banks have been long for weeks. Well, that's not true. Um, the COT report is actually almost perfectly split between the commercials long and short. So it's never a case of the banks are long and the specs are short. That's not the way the market works. There is always a certain amount of commercial traders that are long and a certain amount that are short. Same thing with the large specs, the hedge funds. There's always some that are short and there's always some that are long. It's the net position between them that usually swings the market, and it's basically the commercials control the market. So for the most part, it's commercial traders fighting commercial traders, and when the commercials swing a little bit to the plus side, which they are right now, then usually that's when you get a bottom in the market. But um, you still have this problem that the position limits are not being enforced. So you can have two or three large banks, or even one large bank that can do this. They can just dump 15,000 contracts on the market in the space of a couple of minutes, and that will collapse the price. And it doesn't really matter um, whether the net position in the commercials are long or short. You've got one person or one bank, one or two, three entities that the rules are not enforced and they can control price. So, if you believe that markets are allowed to trade freely and naturally, like I said, you might as well just start giving your money to the banks. It's just this hasn't been the case since the SEC banned short selling in financials back in the fall of 2008. That was the end of free markets as we know them. Um, we are now in an era of managed markets, and if you don't accept that fact and allow for it, then you're probably going to lose money. Now you'll get lots of newsletter writers that will, this is just standard policy for most newsletter writers. They'll give you, alternate wave counts or, both sides of the coin, both scenarios, and then, after the fact, they'll claim to have called, a perfect bottom. None of these people are ever going to make real-time trades. None of these people have ever entered my challenge. And so, as it pertains to the gold market, right in here, I saw, these attacks that were preventing gold from getting above the 200-day moving average. And let me put that 200-day moving average in. All right. So when I saw these multiple attempts to get back above the 200-day moving average, and these overnight attacks, it was a warning flag going off that something was going on and we needed to be careful. That was the point at which I changed tactics. We started playing with very tight stops, and we avoided this entire mess. And as of our last trade, anyway, the SMT metal portfolio has gone from $100,000 at the end of the bear market in, was it January or February of 2016, to $536,000 as of the closing of our last trade. And in the challenge, the SMT metal portfolio is up 10% since the challenge started in the beginning of July. And that's despite this huge sell-off, and we made no money on the short side. But I'm making real trades. I'm not giving people alternate scenarios and then a month later, after I know what the outcome is, claiming that I picked the exact bottom, or I traded it perfectly. That's again, that's just the tactics that 99% of newsletter writers use to pad their results and sell subscriptions. That's not what I'm doing here. I'm making real-time trades in real-time portfolios. We take losses just like everybody does, but over time we are growing both of the portfolios. The stock portfolio, as of the last trade, was at a new all-time high, up about 170%, I believe, over the last 2 years. Let me check that. No, actually, I guess it's up 182% over the last 2.5 years. And like I said, the metal portfolio has gone from $100,000 to $536,000 during the last 2.5 years. So we're making, we're not winning on every trade, but we are consistently growing the portfolio. So instead of, most traders take 3 steps forward and then 4 steps back, we're taking 3 steps forward, 1 step back, 2 steps forward, 1 step back, and we're consistently growing the portfolio, whereas most traders are consistently shrinking, or they're stagnant, or most newsletter writers are consistently making alternate wave counts, and most of them are never going to actually make real-time trades. So today, FOMC meeting. The market is known for months that the Fed's going to raise rates. Today, the Fed does not lead the market. This is a common misconception. The Fed does what the market tells it to do. When the odds are above 70%, then the Fed is going to raise rates. They're not going to create waves. If the odds are below 70%, especially below 50%, then the Fed is not going to raise rates. They're not going to risk causing any kind of major disruption in the bond markets. They're going to do exactly what the market tells them to do. And the market has been pricing in an almost 100% chance of a rate hike for months now. So they are going to hike rates 0.25% today. And that's all been priced into the market for months and months. So there's not going to be any surprise today. We've been expecting that gold was going to take a hit today. We expect that the dollar would get a bounce, probably. Switch this over to the dollar. Probably some kind of a temporary bounce, but as I explained, we've already got a failed cycle, and you see we've already moved below this daily cycle low, so we're already creating this pattern of lower lows and lower highs. So I think any bounce on the rate hike is just going to be a knee-jerk reaction, probably by dumb money that doesn't, that actually thinks the Fed is controlling rates, and they're going to buy the news of the rate hike. But any smart money trader has known for months and months that the Fed was going to hike rates, and if that was actually going to make any difference, the dollar would not be in this downtrend. So I expect any bounce in the dollar today to be brief. It may even reverse today, but I don't think this is done by any means. So we've been expecting an attack on gold. We're getting it this morning, so that's not that's no surprise to us. We're expecting this, but I also think that the dollar is probably going to reverse later today or by the end of the week, and I think gold will probably reverse this early morning attack. And again, I showed you on the 5-minute chart. We've got 4,000 and 5,000 contracts being dumped here. So this is just something that we anticipated. We understand that we live in a world of managed markets, and you just have to anticipate these things if you're going to make money in these kind of markets.